Which factor is not something a corporation must consider when making an investment decision? Whether you can accurately calculate the guaranteed return on the investment. Nothing is guaranteed in finance. Uncertainty is an essential factor in finance. Which answer does not represent how finance is used in organizations. To maximize short-term profit, finance focuses on cash flow and not profit. Which answer best summarizes how the fields of accounting, finance, and economics relate to each other. Accounting is backwards looking, finance projects forward, and economics studies cause and effect. Accounting reflects decisions that are already made. Finance looks at the impact of decisions to be made. Economics seeks to explain how business decisions are made. Which answer gives a definition of finance? The study of fund management and asset allocation over time. Fund management and asset allocation encompass the entire function of finance. Which concept describes the underlying driver behind all finance? Time. Finance is forward-looking. How does finance differ from accounting? Focuses on the future and making decisions based on past information, while accounting is concerned with organizing and compiling past information. What is the main goal of accounting? Is to organize and compile past information. Why is time considered important in finance? Because finance focuses on the future and making decisions based on future outcomes. How does finance impact the economy? By influencing investment decisions, capital allocation, and overall economic growth. What is the distinction between accounting and finance in terms of time orientation? Accounting focuses on the past, while finance focuses on the future. What is the main purpose of finance? Is to make decisions about how to use financial resources effectively to achieve goals. What is the relationship between finance and business scenarios? Finance plays a role in various management positions and business scenarios by providing the knowledge and tools to make financial decisions. How does accounting contribute to the field of finance? Provides the necessary historical financial information that serves as a basis for making informed financial decisions in finance. What is finance? Is the study of fund management and asset allocation over time. What are the three main areas of finance? Are financial institutions, financial markets, and financial management. What are the two main drivers of finance? Are the time value of money and risk. Why is time important in finance? Because the value of assets changes over time, and finance seeks to ensure that change is beneficial. What do financial professionals do in an environment of uncertainty? Financial professionals make forecasts about future events despite operating in an environment of uncertainty. DeFi investment is placing capital with the expectation of deriving income or profit from its use. What is an asset? Is something of value, including money or other possessions. Who is a debtor? Is a person or firm that owes money or is in debt. What is the primary driver of all finance? Time is the primary driver of all finance. Why is the time value of money important? Money today is worth more than the same amount in the future due to various factors, such as inflation and the ability to earn interest. What is the risk associated with making investments? There is no guarantee of a return on an investment. There is always a risk of losing money or not receiving the expected returns. How does finance view time in managing assets? Finance utilizes the understanding that assets change in value over time to manage them in a way that increases their worth in the future. What is one of the challenges in finance? Uncertainty is a major challenge in finance, as it requires decision-making in situations where variables are unknown. What is the role of financial professionals in companies? Help companies determine the best course of action and make informed decisions about managing your assets. How does finance relate to fund management and asset allocation? On studying how to allocate funds and assets effectively in different conditions over time. What are the main areas of finance? Are financial institutions, financial markets, and financial management. Why is risk an important consideration in finance? Because investments and financial decisions come with the possibility of not achieving the expected outcomes. How do financial professionals deal with uncertainty? Financial professionals make forecasts and use their expertise to make the best possible decisions in uncertain situations. What is the time value of money? Refers to the idea that money has greater value when received sooner rather than later due to factors like inflation and the potential for earning interest. Why do companies hire financial professionals? To help them analyze options, make informed decisions, and manage their assets effectively. What are the challenges in finance when it comes to decision making? Uncertainty and the presence of multiple options make decision-making challenging in finance. How does finance prepare individuals to make decisions about assets? Provides knowledge and tools to individuals to make decisions that maximize the value and growth of assets over time. What is the primary focus of financial management? Is effectively managing financial resources to achieve organizational goals. What does the term investment mean in finance? Refers to placing capital with the expectation of earning income or profit from it. How does finance help in asset allocation? Finance provides frameworks and strategies to allocate assets in a way that maximizes their value and meets the financial goals of individuals or organizations. What are the key drivers of finance? Are the time value of money and risk. What is the role of financial institutions in finance? Play a crucial role in providing financial services such as banking, insurance, and investment management to individuals and businesses. How does finance address the concept of risk? Finance assesses and manages risk by considering potential uncertainties and implementing strategies to mitigate or minimize its impact. How does finance influence decision-making in organizations? Provides insights, analysis, and financial models that help organizations make informed decisions about investments, funding, and resource allocation. What distinguishes finance from other fields like accounting? Focuses on studying how to allocate and manage financial resources over time, while accounting primarily deals with organizing and recording past financial information. What are the foundational principles of finance? Include understanding the time value of money, assessing and managing risk, and making informed investment decisions. How does finance consider the future in its decision-making? Considers future outcomes and trends to guide decision-making and ensure the optimal allocation of resources for long-term success. What role does finance play in achieving financial goals? Provides the knowledge and tools necessary to make strategic decisions that align with and contribute to achieving financial goals. How does finance adapt to uncertainty in the business environment? Finance professionals analyze data, assess risks, and develop strategies to navigate uncertainties and make sound financial decisions. What is the significance of financial markets in finance? Provide a platform for buying and selling financial assets, enabling individuals and organizations to raise capital, invest, and manage their financial resources. What is the primary focus of finance? Is determining how individuals and organizations should invest assets to achieve the highest possible return over time. How does finance differ from economics and accounting? Focuses on asset allocation and future value. Economics analyzes production, distribution, and consumption, and accounting focuses on communicating a business's financial information. What does economics study? The social science that analyzes the production, distribution, and consumption of goods and services. How does economics approach the study of cause and effect? Economics examines how variables impact economic agents and the economy as a whole. What is accounting concerned with? Accounting focuses on communicating a business's financial information and understanding its past financial performance. Why is accounting considered a backward-looking field? Accounting looks at past financial events and their impact on a company's current financial position. What is the language of business? Accounting is often referred to as the language of business. What are financial statements? Are documents prepared by accountants that communicate a business's financial information. What do financial statements help determine? Help assess the financial health of a company and enable comparisons with other companies. How do finance, economics, and accounting overlap? As finance uses accounting to analyze past financial performance, economics to understand the overall economy, and accounting to predict future outcomes, why is it important to have a basic understanding of finance, economics, and accounting? These fields influence and interact with each other, and a basic understanding of all three is essential to have a comprehensive grasp of business principles. What does finance focus on when allocating assets? Focuses on optimizing asset allocation to achieve the highest possible return given changing conditions over time. What is the fundamental nature of finance? Finance is forward-looking, concerned with assessing the future value of assets. How does economics analyze the production, distribution, and consumption of goods and services? Economics studies how economic agents interact and make decisions, exploring the cause and effect relationships in these processes. What does accounting primarily deal with? With communicating a business's financial information and assessing its past financial performance. How are financial statements useful for comparing companies? Are prepared under standardized accounting laws, making it easier to compare and contrast companies' financial health. Why is it important for investors to consider economics and finance? Need to understand the overall economy and how a company's financial performance may be influenced by economic factors to make informed investment decisions. How do finance, economics, and accounting intermingle? As they influence and inform one another, with overlapping concepts and analyses, what is the significance of asset allocation in finance? Is crucial for optimizing investment decisions and achieving desired returns. What are the main areas of focus in economics? Include analyzing production, distribution, consumption, and the behavior of economic agents. How does accounting contribute to decision-making in businesses? Provides financial information that aids decision-making by assessing past performance and current financial status. What is the relationship between accounting and financial statements? Involves the preparation of financial statements to communicate a business's financial information. How do finance, economics, and accounting enhance understanding in business contexts? By studying finance, economics, and accounting, individuals gain a comprehensive understanding of how assets are allocated, economic factors influence decisions, and financial information is communicated. How does finance assist individuals and organizations in asset allocation? Provides tools, strategies, and analyses to help individuals and organizations make informed decisions about asset allocation to maximize returns. How does economics contribute to understanding the behavior of economic agents? Economics analyzes how individuals, businesses, and governments interact and make decisions in the production, distribution, and consumption of goods and services. How does accounting provide a historical perspective on a business's finances? Accounting looks at past financial transactions and events to assess a business's financial performance and its impact on the present. Why is it important for finance, economics, and accounting to overlap in business studies? Allows for a holistic understanding of the financial and economic aspects of business decision-making. How does finance consider changing conditions over time in asset allocation? Finance takes into account the dynamic nature of asset values and changing market conditions to optimize the allocation of resources. What distinguishes economics as a social science? Economics examines human behavior and decision-making within the context of production, distribution, and consumption of goods and services. How does accounting enable comparisons between companies? Accounting standards and financial statements provide a common language for evaluating and comparing the financial performance of different companies. Why is it important for investors to understand the interplay of finance, economics, and accounting? Understanding the interplay helps investors make informed decisions by considering economic factors, financial performance, and asset allocation. What does finance focus on when evaluating? Are financial institutions, financial markets, and financial management? What is the purpose of financial institutions? Facilitate the flow of funds in the economy, providing services such as banking, lending, and investment management. How do financial markets contribute to the economy? Provide a platform for buying and selling financial assets, allowing individuals and organizations to raise capital and invest. How does financial management contribute to the overall financial health of an organization? Involves making strategic decisions to ensure the optimal use of resources and the long-term financial success of an organization. What is the role of risk in finance? Risk is a key consideration in finance as it influences investment decisions and the potential return on investments. What is the relationship between finance and risk management? Finance professionals employ risk management strategies to mitigate potential losses and protect assets. How do financial decisions impact the value of assets? Sound financial decisions can increase the value of assets and enhance the financial health of individuals and organizations. What is finance? Is the study of how money is managed and allocated in various contexts, including personal finances, business operations, and the overall economy. Why is finance relevant to everyone, regardless of whether they have studied finance? Finance plays a crucial role in the overall economy and impacts individuals' personal finances and investment decisions. How does finance contribute to the health of the overall economy? Finance explains economic phenomena, influences business and government decisions, and helps understand economic crises like the 2008 recession. Why is understanding finance important for individuals? Individuals need to make investment and financing decisions, such as managing personal savings, evaluating loans, and planning for financial goals. What role does finance play in everyday life? Finance affects people's lives through news stories, stock market fluctuations, and the economic decisions made by businesses and governments. How do individuals make investment decisions? Individuals need to project and evaluate investment options, just like companies, to determine the best investment choices for their personal needs. How do individuals manage their personal finances? Individuals can make financial decisions by considering projections, valuations, and comparing different options for leveraging their resources, such as savings or loans. Why is financial comparison and leverage important for individuals? Similar to companies, individuals need to compare options and consider leverage to make informed financial decisions and manage their personal finances effectively. In what ways does finance apply to various job roles within a company? Finance is relevant to jobs ranging from investment banker to CFO to venture capitalist. Nearly every job requires budget management and making a business case for funding. Why do managers, directors, and vice presidents need to understand finance? Managers and leaders need to justify financial support for their departments and projects, making a strong business case to secure necessary funding. How does finance help develop analytical skills? Finance involves analyzing financial data, evaluating investment options, and making informed decisions based on available information, developing strong analytical skills. Why is personal judgment important in the field of finance? While finance relies on analytical skills, the real world is often uncertain, requiring personal judgment to navigate complex financial situations. What types of decisions are made in finance? Finance involves investment decisions, financing decisions, budget management, risk assessment, and strategic financial planning. What distinguishes finance from other business subjects? Finance focuses on the management of funds and assets over time, while economics analyzes the broader production, distribution, and consumption of goods and services, and accounting focuses on recording and communicating financial information. Why is finance important for companies to make financial arguments and manage their budgets? Finance enables companies to present a strong financial case for project funding, allocate resources effectively, and monitor their financial performance. How does finance help individuals make investment decisions? Finance provides individuals with tools and knowledge to assess investment options, evaluate risks and returns, and make informed choices aligned with their financial goals. Why is it important for individuals to have a grasp of finance? Understanding finance empowers individuals to make informed decisions, manage their personal finances effectively, and navigate financial challenges. How does finance contribute to the success of businesses? Finance provides insights and strategies to optimize financial resources, allocate funds to profitable projects, and ensure the financial health and growth of businesses. Why is finance relevant to the macroeconomy? Finance influences economic activities, capital allocation, investment patterns, and overall economic stability, impacting the welfare of individuals and society. What is leverage in finance? Leverage refers to the use of borrowed funds to increase the potential return on investment, although it also comes with higher risks. How does finance help individuals understand the events of the world? Finance provides individuals with a better understanding of how global events, economic trends, and financial decisions affect their personal financial situation and well-being. Why is it important for individuals to compare options in personal finance? Comparing options allows individuals to make informed choices, evaluate the potential benefits and risks, and optimize their personal financial outcomes. What skills are developed through studying finance? Studying finance develops analytical skills, financial literacy, decision-making abilities, risk assessment, and strategic planning skills. How does finance influence personal financial goals? Finance helps individuals plan and manage their financial resources effectively, aligning their decisions with their long-term financial goals. Why is finance considered a broad field of study? Finance encompasses various areas, including personal finance, corporate finance, investments, financial markets, financial planning, and risk management. How does finance contribute to economic decision-making? Finance provides insights into the financial implications of economic decisions, helping individuals and organizations assess risks, rewards, and optimal resource allocation. What role does finance play in the success of investment decisions? Finance helps evaluate investment opportunities, assess their potential returns and risks, and make informed decisions to maximize investment outcomes. How does finance support the financial health of businesses? Finance helps businesses manage their budgets, monitor financial performance, access funding, and make strategic decisions to ensure profitability and growth. Why is understanding finance valuable in personal and professional contexts? Understanding finance enables individuals to make sound financial decisions, effectively manage resources, and contribute to personal and professional success. What distinguishes finance as a field of study? Finance focuses on the study of financial management, asset allocation, investment analysis, financial markets, and decision-making in various financial contexts. How does finance contribute to the evaluation and measurement of financial success? Finance provides tools and metrics to assess financial performance, measure returns on investment, and evaluate the achievement of financial goals. How does finance impact financial decision-making in organizations? Finance guides organizations in making strategic financial decisions, including investment choices, capital structure, risk management, and financial planning. Why is finance important for individuals' long-term financial stability? Finance equips individuals with the knowledge and skills to make informed financial decisions, plan for the future, and achieve their financial goals. How does finance relate to risk management? Finance helps individuals and organizations assess and manage risks associated with financial decisions, investments, and overall financial strategies. What areas of personal finance are influenced by finance principles? Personal finance areas such as budgeting, savings, investment planning, retirement planning, and debt management are influenced by finance principles. How does finance contribute to economic growth and development? Finance facilitates capital allocation, mobilizes savings, supports entrepreneurship, and promotes investments, driving economic growth and development. Why is finance relevant to individuals' financial well-being? Finance knowledge empowers individuals to make informed decisions about saving, investing, and managing their money, improving their financial well-being. How does finance impact business operations beyond financial functions? Finance influences strategic decision-making, resource allocation, risk assessment, and performance evaluation in various business functions. What role does finance play in managing financial resources? Finance provides frameworks, tools, and strategies to effectively manage financial resources, ensuring their optimal utilization and growth. How does finance help individuals and businesses adapt to changing economic conditions? Finance provides insights and strategies to navigate economic uncertainties, assess market trends, and adjust financial plans to achieve desired outcomes. Why is finance considered an essential skill in today's professional landscape? Finance knowledge enhances employability, enables effective financial decision-making, and supports individuals in achieving financial success and stability. How does finance contribute to wealth creation and financial security? Finance principles guide individuals and businesses in making sound investment choices, managing risks, and accumulating wealth over time. What is the relationship between finance and financial institutions? Finance encompasses the study of financial institutions, such as banks, insurance companies, and investment firms, examining their role in the economy and financial markets. How does finance support informed decision-making in business scenarios? Finance provides tools and analysis to evaluate different options, assess risks and rewards, and make data-driven decisions that align with business objectives. Why is finance an interdisciplinary field? Finance incorporates elements from economics, mathematics, statistics, psychology, and other disciplines to analyze financial phenomena and make informed decisions. What is the primary role of corporate finance? Is to maximize shareholder value. What is the function of the finance department in maximizing shareholder value? The finance department determines how best to allocate assets and manage liabilities to achieve the goal of maximizing shareholder value. How does the finance department ensure assets are allocated appropriately? Ensures that the right assets are in the right place at the right time to support the company's goals. What is the difference between short-term and long-term goals in corporate finance? Short-term goals focus on immediate gains, such as paying dividends, while long-term goals involve investments for future growth and increased shareholder wealth. Can short-term and long-term goals in corporate finance be in competition with each other? Yes, short-term and long-term goals may sometimes appear to contradict each other, requiring the finance department to balance their priorities. How does the finance department assess investment opportunities? The finance department evaluates future revenues and costs associated with investment proposals to determine which options are worth the money. What is the role of the finance department in managing liabilities? The finance department determines when and how the company should take on liabilities, such as borrowing money, to fund investments and projects. Why is it important for the finance department to manage liabilities effectively? Effective management of liabilities ensures that projects are financed optimally without taking on excessive risk. What is the ultimate goal of finance in an organization? To ensure that money is allocated to the right place at the right time, with the overarching goal of maximizing shareholder value. What is the technique behind maximizing shareholder value? The technique involves the management of assets, where the finance department determines the best investments and financial decisions to maximize shareholder value. How does the finance department determine the worth of investment options? The finance department projects future revenues and costs associated with investment options to assess their potential return on investment. When a company has limited funds, how does the finance department make decisions about which projects to fund? The finance department compares the potential returns and long-term value of different projects to determine the best allocation of limited funds. What is the overarching goal of finance in relation to shareholder value? Is to make decisions and allocate resources in a way that maximizes the value of shareholders' investments. Why is the role of finance important in managing a company's finances? The finance department ensures that the company has enough funds to meet its financial obligations while also investing in growth opportunities. What are some key terms associated with corporate finance? Include business plan, capital, dividend, profit, stock, return, investment, acquisition, accounting, management, just-in-time, balance sheet, analysis, and costs. How does finance contribute to the success of investment decisions? Finance provides analysis, projections, and evaluation of investment options to support informed decision-making and maximize returns. What types of decisions does corporate finance encompass? Decisions related to investments, financing, capital allocation, risk management, and financial planning. How does finance impact the overall financial health of a company? Finance ensures that financial resources are managed effectively, liabilities are controlled, and investment decisions align with the company's financial goals. What is the relationship between finance and shareholder wealth? Finance plays a critical role in maximizing shareholder wealth by making strategic financial decisions and allocating resources efficiently. How does corporate finance differ from other branches of finance? Corporate finance specifically deals with financial decisions made by business enterprises, while other branches like personal finance focus on individual financial management. What factors does the finance department consider when deciding on asset allocation? The finance department considers future projections, risk assessments, market conditions, and strategic goals when allocating assets. Why is the finance department responsible for managing liabilities? Ensures that projects are appropriately funded, avoiding excessive debt and financial risk. What are some challenges the finance department faces in maximizing shareholder value? The finance department must balance short-term and long-term goals, assess investment opportunities, manage liabilities, and navigate uncertainty in financial decision-making. How does finance contribute to the overall success of an organization? Finance provides strategic guidance, resource allocation, risk management, and financial planning to support the achievement of organizational goals. Why is the understanding of corporate finance important for management roles? Require the ability to make financial arguments, manage budgets, and understand the financial implications of decisions, which are fundamental aspects of corporate finance. What distinguishes corporate finance from managerial finance, specifically deals with financial decisions made by corporations, while managerial finance covers financial decisions in all types of companies? How does corporate finance relate to the concept of shareholder ownership? Focuses on maximizing shareholder value since shareholders are the owners of a corporation and have a vested interest in its financial success. What role does finance play in business planning? Provides financial analysis, forecasting, and budgeting to support effective business planning and resource allocation. How does finance help companies manage financial risks? Finance provides tools and strategies to assess, mitigate, and manage financial risks, ensuring the company's financial stability and resilience. Why is the finance department crucial for making informed financial decisions? The finance department possesses financial expertise, data analysis skills, and knowledge of financial principles, enabling them to make informed decisions that align with the organization's financial goals. How does corporate finance impact shareholders' investment returns? By making sound financial decisions and allocating resources efficiently, corporate finance aims to maximize shareholders' investment returns. How does finance contribute to the overall success and profitability of a company? Finance guides strategic financial planning, resource allocation, and investment decisions, which are crucial for achieving sustainable growth and profitability. Why is maximizing shareholder value a key objective in corporate finance? Maximizing shareholder value ensures that the company is operating in the best interest of its shareholders and generating returns on their investments. How does finance support management roles in justifying project funding? Finance provides tools and analysis to help managers make a financial case for project funding, demonstrating the potential returns and benefits for the company. What is the role of finance in managing the financial health of an organization? Finance oversees budgeting, financial reporting, cash flow management, and financial analysis to maintain the financial health and stability of the organization. How does finance assist in evaluating investment opportunities? Finance utilizes techniques such as financial modeling, discounted cash flow analysis, and risk assessment to evaluate investment opportunities and their potential returns. What role does finance play in managing working capital? Finance manages working capital by optimizing cash flow, monitoring inventory levels, and managing receivables and payables to ensure efficient operations. How does finance contribute to strategic decision-making in an organization? Finance provides financial insights, analysis, and forecasting to support strategic decision-making, helping to align business goals with financial objectives. Why is financial planning important in corporate finance? Financial planning ensures that the company's financial resources are effectively allocated, risks are managed, and financial goals are achieved. How does finance contribute to cost management in an organization? Finance helps in identifying cost-saving opportunities, analyzing cost structures, and implementing strategies to optimize costs and improve profitability. What role does finance play in capital budgeting decisions? Finance evaluates investment proposals, assesses their financial feasibility, and determines the allocation of capital resources to support the most promising projects. How does finance support risk management in an organization? Finance analyzes and assesses financial risks, implements risk management strategies, and ensures the company's financial stability in uncertain environments. Why is financial analysis important in corporate finance? Financial analysis provides insights into the company's financial performance, profitability, liquidity, and overall financial health, enabling informed decision-making. What is the relationship between finance and business strategy? Finance aligns with business strategy by providing financial support, evaluating investment opportunities, and ensuring financial resources are allocated to support strategic goals. How does finance contribute to value creation in a company? Finance helps create value by identifying profitable investments, optimizing capital structure, managing costs, and maximizing shareholder returns. What is the role of financial managers within an organization? Financial managers ensure the financial health of an organization through investment activities and long-term financing strategies. What is the primary responsibility of financial managers in the past compared to the present? In the past, financial managers primarily monitored a company's finances, but now they perform more data analysis and advise senior managers on profit-maximizing ideas. What are some types of financial managers? Include controllers, treasurers, credit managers, cash managers, risk managers, and insurance managers. What is the role of controllers in financial management? Controllers direct the preparation of financial reports, including income statements and balance sheets, and oversee accounting, audit, and budget departments. What are the responsibilities of treasurers and finance officers? Treasurers and finance officers direct budgeting, oversee investment of funds, raise capital, and develop financial plans for mergers and acquisitions. What role do credit managers play in financial management? Credit managers set credit rating criteria, determine credit ceilings, and monitor collections of past due accounts. What is the role of cash managers? Monitor and control the flow of cash in and out of the company to meet its business and investment needs. How do risk managers contribute to financial management? Control financial risk by using hedging and other strategies to limit or offset the probability of financial loss or exposure to financial uncertainty. What is the role of insurance managers in financial management? Decide how best to limit a company's losses by obtaining insurance against risks, such as disability payments for employees or costs imposed by lawsuits. What are some important skills for financial managers? Include analytical skills, communication skills, attention to detail, math skills, and organizational skills. Why do financial managers need analytical skills? To assist executives in making decisions that affect the organization's financial health. Why are communication skills important for financial managers? To explain and justify complex financial transactions to stakeholders. Why is attention to detail crucial for financial managers? When preparing and analyzing reports, such as balance sheets and income statements. What math skills are important for financial managers, including algebra, to perform financial calculations and understand complex financial documents? Why are organizational skills necessary for financial managers? Deal with a range of information and documents, so organizational skills are crucial for effective performance. What is net present value, NPV? Net present value is the present value of a project or investment decision determined by summing the discounted future cash flows resulting from the decision. What are the key criteria for capital investment decisions? Consider the net present value, size, timing, and predictability of future cash flows in relation to an appropriate discount rate and risk assessment. How does corporate management maximize shareholder value through capital investment decisions? Seeks to invest in projects that yield a positive net present value, ensuring value creation and appropriate financing and dividend decisions. What is the role of financial managers in capital budgeting? Financial managers allocate limited resources among competing opportunities, projects, through capital budgeting, considering the value and potential cash flows of each opportunity. What are some specific responsibilities of government financial managers? Government financial managers must be experts in government appropriations, budgeting processes, and regulations that affect their industry. What industry-specific knowledge is required for healthcare financial managers? Must have knowledge of healthcare finance issues and regulations specific to the healthcare industry. Why is it important for financial managers to be aware of tax laws and regulations? Financial managers need to navigate special tax laws and regulations that impact their industry and ensure compliance in financial decision-making. How do financial managers contribute to the financial health of an organization? Financial managers produce financial reports, direct investment activities, develop long-term financial strategies, review company financial reports, and analyze market trends to reduce costs and identify expansion opportunities. Why is data analysis important for financial managers? Financial managers perform data analysis to identify profit-maximizing ideas, support decision-making, and provide insights to senior managers. How has the role of financial managers changed in response to technological advances? Technological advances have reduced the time it takes to produce financial reports, leading financial managers to focus more on data analysis and advising senior managers on profit-maximizing strategies. What is the purpose of financial statements prepared by financial managers? Financial statements provide a summary of an organization's financial position, including income statements, balance sheets, and analyses of future earnings or expenses. What is the significance of an income statement prepared by financial managers? Shows the revenue, cost of goods sold, gross profit, operating expenses, and net operating profit/income, EBIT, of an organization. How do financial managers contribute to reducing costs in an organization? Review company financial reports to seek ways to reduce costs. Analyze market trends and identify opportunities for cost reduction. What are some tasks specific to financial managers in different industries? Financial managers in different industries, such as government or healthcare, have industry-specific responsibilities related to regulations, appropriations, and healthcare finance issues. Why is the strategic investment of funds important for treasurers and finance officers? Develop financial plans, raise capital, and oversee investment of funds to meet the organization's financial goals. What role do credit managers play in managing the firm's credit business? Credit managers set credit rating criteria, determine credit ceilings, and monitor the collections of past due accounts to ensure the firm's creditworthiness. How do cash managers contribute to meeting the company's financial needs? Cash managers monitor and control the flow of cash to ensure the company has enough cash to meet its business and investment requirements. What strategies do risk managers employ to control financial risk? Risk managers use hedging and other strategies to limit or offset the probability of financial loss or exposure to financial uncertainty. How do insurance managers help limit a company's losses? Insurance managers obtain insurance against various risks, such as disability payments or costs imposed by lawsuits, to mitigate potential losses for the company. How do financial managers assist senior managers in decision-making? Financial managers provide data analysis, financial reports, and forecasts to advise senior managers on profit-maximizing ideas and financial decision-making. Why is it essential for financial managers to stay updated on market trends? Financial managers analyze market trends to identify opportunities for expansion, potential risks, and make informed financial decisions. What are the key skills needed for financial managers to perform data analysis effectively? Financial managers need strong analytical skills to perform data analysis, interpret financial reports, and make informed decisions. What role does financial management play in achieving long-term financial goals? Financial managers develop strategies and plans to achieve the long-term financial goals of an organization through investment activities and financing decisions. Why is maximizing shareholder value an important goal in financial management? Maximizing shareholder value ensures that financial decisions and activities contribute to the overall financial success and profitability of the organization. How do financial managers contribute to the overall financial strategy of an organization? Financial managers provide financial analysis, forecasting, and budgeting to support strategic decision-making and resource allocation. What role does financial management play in budgeting and cost management? Financial management oversees budgeting, cost analysis, and cost management to ensure efficient resource allocation and financial control. How do financial managers contribute to risk management in an organization? Financial managers assess and manage financial risks, implement risk management strategies, and ensure the organization's financial stability in uncertain environments. What is the relationship between financial management and financial reporting? Financial management involves preparing financial reports and statements that provide insights into the organization's financial performance, which supports decision-making. How does financial management support investment decisions? Financial management evaluates investment opportunities, assesses their financial viability, and determines the allocation of resources to support the most promising projects. Why is financial planning important in financial management? Financial planning ensures that financial resources are allocated effectively, risks are managed, and financial goals are achieved in line with the organization's strategic objectives. What is the role of finance in business scenarios? Finance helps companies make sound financial decisions, manage assets, allocate resources, and achieve their financial goals. What is corporate finance primarily concerned with? With making investment and financing decisions to ensure that money is used optimally. What is the responsibility of the finance department in budgeting? The finance department is responsible for budgeting and determining the optimal allocation of assets across all business functions. How does the finance department value projects and business functions? The finance department incorporates variables like inflation, expected revenues, expected costs, and time required to determine the value of projects and business functions. What are the options for financing projects? Projects can be financed using internal funds, borrowing, or selling equity, and the finance department determines the optimal mix of these strategies. How does the finance department determine the amount and frequency of dividends? The finance department evaluates the impact of paying dividends on shareholder value and determines the optimal amount and frequency of dividends. What does it mean for a company to have a good balance between long and short-term goals? Having a good balance between long and short-term goals means ensuring sufficient working capital for short-term costs and investing in long-term growth. What is the overarching goal of corporate finance? The overarching goal of corporate finance is to maximize shareholder value. What is the main challenge in allocating limited resources in corporate finance? The main challenge is determining how much money should be allocated to each part of a business when a dollar cannot be used for more than one project simultaneously. How does the finance department ensure that resources are allocated optimally? The finance department values projects, incorporates various variables, and uses financial analysis to determine the optimal allocation of resources. What factors are considered in the valuation process for projects? Factors such as inflation, expected revenues, expected costs, and the time required are considered in the valuation process for projects. What are the three main financing options for projects? Are internal funds, borrowing, and selling equity. What is the role of the finance department in determining dividends? The finance department evaluates the impact of paying dividends on shareholder value and determines the optimal amount and frequency of dividends. How does the finance department ensure a balance between long and short-term goals? By managing working capital and making strategic investment decisions. How does corporate finance contribute to maximizing shareholder value? Corporate finance ensures that financial decisions, including investment and financing decisions, contribute to maximizing shareholder value. What is the function of the finance department in budgeting? The finance department is responsible for allocating resources, managing budgets, and ensuring optimal asset allocation across the organization. Why is valuation important in corporate finance? Valuation helps determine the true value of projects and ensures optimal allocation of resources. What are the financing options available for companies? Companies can finance projects using internal funds, debt financing, or equity financing. How does the finance department assess the impact of dividend decisions on shareholder value? The finance department analyzes the potential benefits and drawbacks of paying dividends versus reinvesting the money to maximize shareholder value. Why is balancing long and short-term goals important in finance? Balancing long and short-term goals ensures the financial stability of the company and supports sustainable growth. What is the primary goal of corporate finance? Is to maximize shareholder value. What is the role of the finance department in allocating resources? Determines the optimal allocation of resources to different projects and business functions. How does the finance department evaluate the value of projects? The finance department considers various factors and variables, such as expected revenues, costs, and time, to evaluate the value of projects. What are the considerations in choosing a financing option for projects? The finance department assesses the cost and benefits of internal funds, borrowing, and selling equity to determine the optimal financing option. How does the finance department determine the appropriate balance between short and long-term goals? The finance department manages working capital and ensures sufficient investment for long-term growth while meeting short-term financial obligations. How does corporate finance contribute to sound financial decision-making? Corporate finance utilizes tools and analysis to help companies make informed financial decisions and effectively manage their assets and operations. What is the relationship between finance and accounting? Finance and accounting are related fields, but finance focuses on making financial decisions and managing assets, while accounting focuses on recording and reporting financial transactions. What are the types of financial managers in an organization? The types of financial managers include controllers, treasurers, credit managers, cash managers, risk managers, and insurance managers. What is the role of controllers in financial management? Controllers are responsible for preparing financial reports, analyzing financial data, and ensuring compliance with financial regulations. What is the role of treasurers and finance officers in financial management? Treasurers and finance officers oversee budgeting, investment of funds, capital raising, and financial planning for the organization. What is the role of credit managers in financial management? Credit managers set credit rating criteria, monitor credit limits, and manage the collection of past due accounts. How do cash managers contribute to financial management? Cash managers monitor and control the flow of cash within the company to meet business and investment needs. What is the role of risk managers in financial management? Risk managers assess and control financial risks by using strategies such as hedging to mitigate potential losses. How do insurance managers contribute to financial management? Insurance managers evaluate risks and obtain insurance coverage to protect the company from financial losses. What are the important skills for financial managers? Important skills for financial managers include analytical skills, communication skills, attention to detail, math skills, and organizational skills. Why are analytical skills important for financial managers? Financial managers need analytical skills to analyze financial data, evaluate investment opportunities, and make informed financial decisions. How do financial managers use communication skills in their role? Financial managers need excellent communication skills to effectively communicate financial information, justify financial decisions, and collaborate with stakeholders. Why is attention to detail important for financial managers? Financial managers need attention to detail to ensure accurate financial reporting, analyze financial statements, and identify potential errors or discrepancies. What math skills are important for financial managers? Financial managers need math skills, including algebra and financial calculations, to analyze financial data, perform financial modeling, and make accurate financial projections. Why are organizational skills important for financial managers? Financial managers deal with a large amount of information and documents, and organizational skills help them manage and prioritize tasks effectively. What are ethics? Are the set of moral principles that guide a person's behavior. What do ethics reflect? Beliefs about what is right, wrong, just, unjust, good, and bad in terms of human behavior. How are ethical principles and values applied? Ethical principles and values serve as a guide to behavior on a personal level, within professions, and at the organizational level. What is business ethics? Is the branch of ethics that examines questions of moral right and wrong in the context of business practice or theory. How are ethics influenced? Ethics are shaped by social norms, cultural practices, and religious influences. What do ethics serve as? A compass to direct how people should behave, fulfill their obligations to society, and make choices in their lives. What is the role of ethics in decision-making? Ethics provide guidance and shape the choices made by decision-makers on behalf of their organizations. What are professional ethics? Are the ethical standards that professionals, such as managers, lawyers, and accountants, are expected to follow in their respective fields. What are some examples of professional ethics? Include lawyers maintaining client confidentiality and accountants displaying honesty and integrity in their work. What is the concept of corporate social responsibility? Emphasizes ethical behavior and requires organizations to understand, identify, and eliminate unethical economic, environmental, and social behaviors. How do ethics apply to individuals, groups, and organizations? Ethics apply to all aspects of conduct and are relevant to the actions of individuals, groups, and organizations. What influences the formation of ethical beliefs? Are influenced by social norms, cultural practices, and religious beliefs. What role do ethics play in business decision-making? By providing a framework for considering what is morally right and wrong in a business context. How do ethical values shape organizational choices? By influencing policies, practices, and decision-making processes that align with moral principles. How do professional organizations and licensing authorities enforce ethical standards? Through codes of conduct and regulatory measures. What is the relationship between ethics and corporate social responsibility? As it emphasizes ethical behavior and the elimination of unethical practices in economic, environmental, and social contexts. What are the sources of influence on ethical beliefs? Social norms, cultural practices, and religious influences are the sources of influence on ethical beliefs. How do ethics guide behavior at the personal level? Ethics guide personal behavior by providing principles and values that shape how individuals interact with others and make choices in their lives. How do ethics influence decision-making in professions? By providing guidelines for specialized knowledge and skills, ensuring ethical conduct in providing services to customers or the public. How do ethics relate to cultural practices? As they reflect the beliefs and values of a particular culture regarding right and wrong behavior. What is the purpose of ethical standards in professional organizations? Ensure that professionals adhere to a code of conduct and maintain ethical behavior in their respective fields. How do ethics guide behavior at the organizational level? By influencing policies, practices, and decision-making processes that align with moral principles and values. What are the key elements of ethics? Are principles, values, and beliefs that shape behavior and guide decision-making. How do ethics impact corporate decision-making? Ethics provide a framework for considering the moral implications of corporate decisions and help guide choices that align with ethical principles. Why is ethical behavior important in business? Ethical behavior is important in business to maintain trust, reputation, and long-term sustainability, and to ensure fair and responsible practices. How do ethics influence organizational culture? By shaping the values, norms, and behaviors that are expected and promoted within the organization. What are the ethical considerations in corporate social responsibility? Involve identifying and addressing unethical behaviors in economic, environmental, and social aspects of business practices. How do ethics contribute to societal expectations? By defining what is considered morally right and wrong, just and unjust in human behavior. How do ethical principles guide decision-making in business? Ethical principles provide a framework for evaluating the moral implications of business decisions and guide choices that align with ethical standards. What is the role of ethics in creating a responsible and sustainable business? By guiding decisions and actions that consider the well-being of stakeholders and the broader societal impact. How do ethical values influence stakeholder relationships? By promoting fairness, transparency, and accountability in interactions and decision-making processes. How do ethical standards contribute to professional integrity? By establishing expectations for honest, responsible, and ethical behavior within a profession. How can ethics be integrated into business practices? Through the establishment of ethical codes, training programs, and ethical decision-making frameworks. What are the consequences of unethical behavior in business? Can lead to reputational damage, legal consequences, loss of trust, and negative impacts on stakeholders and society. How do ethics influence the decision-making process? By providing a moral framework that considers the ethical implications and consequences of different choices. What role does ethics play in risk management? By guiding decision-making that considers the potential ethical implications and consequences of different risks and mitigation strategies. How do ethical considerations impact financial decision-making? By ensuring that financial decisions align with ethical principles and values, promoting responsible and ethical use of resources. How can businesses ensure ethical behavior throughout their operations? By establishing clear ethical guidelines, promoting a culture of ethics, providing ethical training, and enforcing ethical standards. What is the relationship between ethics and legal compliance? Ethics and legal compliance are interconnected, but ethics go beyond legal requirements by guiding behavior based on moral principles and values. How can businesses address ethical dilemmas? By fostering open discussions, considering multiple perspectives, seeking guidance from ethical frameworks, and making decisions that uphold ethical principles. What are personal values? Are internal references that determine what is good, beneficial, important, useful, beautiful, desirable, and constructive. How do personal values relate to cultural values? Exist in relation to cultural values and can either align with or diverge from prevailing norms. What influences the development of personal values? Are influenced by factors such as family upbringing, interactions with teachers and classmates, and religious beliefs. How do personal values shape behavior in adulthood? In adulthood, Personal values influence how individuals carry out their responsibilities to others, including in the workplace. How do organizations influence employees' personal values? Organizations can have a powerful influence on employees' personal values through their authority structures, social norms, and cultural environment. Why do employers seek to hire individuals who match their organization's norms and values? Employers seek to hire individuals who align with their organization's norms and values to promote standards of ethical behavior within the company. What can happen when there is a conflict between an individual's moral values and those of their organization? Conflicts can arise when an individual's moral values clash with the perceived values of others in their organization, leading to ethical dilemmas. Why is self-awareness of personal values important in making ethical choices? Because it provides a clear understanding of one's moral compass. How can personal values affect job satisfaction and productivity? When personal values align with an organization's values, it can contribute to job satisfaction and increased productivity. Conversely, conflicts in values can negatively impact attitudes and behaviors. What role do personal values play in ethical decision-making? Serve as a guiding framework for ethical decision-making by influencing one's moral judgments and choices. What are some influences on personal values during childhood? Family, teachers, classmates, and religious teachings are influences on personal values during childhood. How do personal values influence an individual's perception of fairness in the workplace? Related to equal rights and fairness can shape an individual's perception of workplace fairness and treatment of employees. Why is it important for managers and leaders to align their personal values with organizational values? Managers and leaders are responsible for overseeing resources and guiding others, so aligning their personal values with organizational values helps promote ethical behavior and effective leadership. How can conflicts in personal values impact job performance and job retention? In personal values, such as perceiving unfairness in the workplace, can lead to reduced job performance and may even result in leaving the organization. What is the significance of understanding personal values in persuasive ethical decision-making? As it allows individuals to justify their decisions based on their values, making them more persuasive to others. How can personal values influence an individual's behavior and attitudes in the workplace? Personal values can influence an individual's behavior and attitudes in the workplace by shaping their perceptions, motivations, and overall engagement. What are some examples of personal values that may impact job satisfaction? Include personal values related to fairness, respect, integrity, equality, and social responsibility, which can impact job satisfaction. Why is self-reflection on personal values important for career decision-making? As it helps individuals align their career choices with their core beliefs and values. How do personal values influence ethical behavior in the workplace? By guiding individuals' choices and actions based on their moral principles. What role does self-awareness play in maintaining ethical integrity? Enables individuals to recognize how their personal values align with ethical standards, supporting them in maintaining ethical integrity. How can personal values impact organizational culture? When shared and aligned within an organization, contribute to shaping its culture and ethical climate. How do personal values contribute to employee engagement? When personal values align with organizational values, it fosters a sense of purpose and alignment, leading to higher employee engagement. How do personal values shape an individual's perception of organizational fairness? In the workplace, particularly when it relates to equality, respect, and ethical treatment. Why is it important for organizations to promote alignment between personal and organizational values? Promoting alignment between personal and organizational values enhances employee satisfaction, commitment, and ethical conduct within the organization. What can organizations do to foster an environment that respects employees' personal values? By creating inclusive policies, providing ethical training, and encouraging open dialogue. How can conflicts between personal values and organizational values be resolved? Conflicts between personal values and organizational values can be addressed through open communication, negotiation, and finding common ground that upholds ethical principles. How can organizations integrate personal values into their decision-making processes? creating frameworks that consider ethical implications and seek input from diverse perspectives. How does the alignment of personal and organizational values contribute to ethical leadership? By promoting consistency, integrity, and ethical decision-making based on shared values. What is the relationship between personal values and professional ethics? Influencing how individuals navigate ethical challenges and make decisions in their professional roles. How can personal values contribute to the development of a positive ethical culture within an organization? Personal values that align with ethical principles contribute to the development of a positive ethical culture by influencing individual behavior and promoting ethical decision-making. Why is it important for individuals to reflect on their personal values in the workplace? Helps individuals maintain alignment with their core beliefs, make ethical choices, and contribute to a positive work environment. How do personal values influence decision-making processes in complex ethical dilemmas? Personal values provide a moral compass that guides decision-making processes in complex ethical dilemmas, helping individuals navigate choices that align with their beliefs. How can personal values shape an individual's commitment to ethical behavior? Personal values provide a strong foundation for an individual's commitment to ethical behavior by reinforcing their sense of right and wrong and guiding their actions accordingly. What role do personal values play in building trust and credibility within an organization? By demonstrating consistency, integrity, and ethical behavior. How can organizations encourage employees to align their personal values with the company's norms? By fostering a values-driven culture, providing ethical guidance, and recognizing and rewarding ethical behavior. What challenges may arise when personal values conflict with organizational values, leading to moral dilemmas, job dissatisfaction, and potential ethical conflicts? How can organizations create an environment that supports employees' expression of their personal values? By fostering inclusivity, respecting diversity, and promoting open dialogue. How can personal values contribute to innovation and creativity within an organization? Personal values that encourage innovation, creativity, and open-mindedness can contribute to a culture of innovation within an organization. What impact can a mismatch between personal and organizational values have on employee morale and job satisfaction, as individuals may feel a lack of alignment with the company's culture and practices? Why is it important for organizations to assess the compatibility of personal and organizational values during the hiring process? Helps ensure a better fit between employees and the company's culture, promoting long-term engagement and ethical behavior. What are the two fundamental types of financial decisions in a business? Are investment decisions and financing decisions. What is the primary goal of both investment and financing decisions? Is to maximize shareholder value. What does an investment decision revolve around? Spending capital on assets that will yield the highest return for the company. Why is finding a balance between short-term and long-term goals important in investment decisions? To ensure both immediate financial obligations are met and long-term growth prospects are maximized. What is an expected return in investment decisions? Is the average return on an investment if it were to be made many times, although is not guaranteed? What criteria must investments meet in order to be considered in investment decisions? Investments must maximize the value of the firm, be financed appropriately, and if no suitable investment opportunity exists, cash must be returned to shareholders. What is the role of the finance department in financing decisions? The finance department is responsible for figuring out how to pay for company functions and investments through the process of financing. What are the two ways to finance an investment? Are using a company's own money or raising money from external funders? What is the cost associated with taking on debt in financing decisions? The cost of taking on debt is the interest that needs to be paid back along with the loan. What does it mean to sell equity in financing decisions? Means selling a part of the company, often through issuing stocks or going public, in exchange for money. What does the financing decision process determine? The optimal way to finance an investment, considering various options and their advantages and disadvantages. How does investment decision-making contribute to maximizing shareholder value? Aims to allocate capital in a way that maximizes the value of the firm, thus increasing shareholder value. Why is risk aversion an important consideration in investment decisions? To ensure that the level of risk taken aligns with the company's comfort level and goals, what are some potential sources of external funding in financing decisions? Include loans from financial institutions, issuing bonds, or selling equity to investors. How does the financing decision process impact the overall cost of an investment? Decision process determines how the investment will be financed, and each financing option comes with its own costs, such as interest payments or dilution of ownership. What factors should be considered when determining the optimal way to finance an investment? Factors such as cost, risk, availability of funds, and the company's long-term financial strategy should be considered when determining the optimal way to finance an investment. How do investment decisions and financing decisions complement each other? Determine how to allocate capital, while financing decisions determine how to pay for those investments, ensuring a balance between spending and funding. Why is it important for companies to find the right mix between long-term and short-term investment? Allows companies to meet immediate financial obligations while also investing in future growth. How can investment decisions contribute to the long-term success and competitiveness of a company? Well-informed investment decisions can lead to the acquisition of valuable assets, expansion into new markets, and the development of innovative products, which contribute to long-term success and competitiveness. What role does the finance department play in determining the appropriate financing strategy for investments? Department analyzes available financing options, assesses their costs and risks, and determines the most suitable financing strategy for investments. How can financing decisions impact the capital structure of a company? Determine the mix of debt and equity used to finance the company's operations and investments, which affects its capital structure. Why is it important for companies to consider the cost of financing options in their decision-making process? Considering the cost of financing options helps companies evaluate the financial implications and profitability of investments, ensuring that the overall cost is reasonable and aligns with the company's goals. What are the advantages of using a company's own money to finance investments? Reduces dependence on external sources, avoids interest costs, and allows the company to maintain control over its assets. How does selling equity in financing decisions impact ownership and control of the company? Selling equity to external investors dilutes existing ownership and may involve giving up control of the company to some extent, depending on the terms of the equity sale. What is the role of risk assessment in both investment and financing decisions? Helps in evaluating the potential risks associated with investment projects and financing options, enabling informed decision-making and risk mitigation strategies. How does the finance team ensure that investment decisions are aligned with the company's overall financial strategy? Team evaluates investment opportunities based on their alignment with the company's financial goals, risk tolerance, and long-term strategic plans. What considerations should be made when deciding between debt financing and equity financing? Include the cost of borrowing, potential dilution of ownership, the company's cash flow capacity, and the level of control the company wants to maintain. How does the finance department determine the expected return on investments? Department uses various financial models, market analysis, and risk assessments to estimate the expected return on investments. What are the potential risks associated with borrowing money for financing investments? Include interest rate fluctuations, repayment obligations, potential default, and increased financial leverage. How do investment decisions contribute to the growth and competitiveness of a company? Well-planned investment decisions enable companies to acquire new assets, expand operations, improve efficiency, and develop competitive advantages, leading to growth and enhanced competitiveness. How does the financing decision process consider the cost of capital? By evaluating the cost of different financing options and selecting the most cost-effective and sustainable solution. How can financing decisions impact the financial flexibility of a company? Financing decisions determine the company's financial structure and its ability to access additional funds in the future, thus impacting its financial flexibility. What factors should be considered when determining the optimal capital structure for a company? Factors such as the company's risk profile, industry norms, cash flow generation, and future growth plans should be considered when determining the optimal capital structure. How does the finance department ensure that financing decisions align with the company's overall financial goals? Assesses financing options based on their alignment with the company's financial strategy, risk appetite, and long-term objectives. What role does the finance team play in managing financial risks associated with investment and financing decisions? The finance team assesses and manages financial risks by conducting risk analysis, implementing risk mitigation strategies, and monitoring the financial performance of investments and financing arrangements. How does the finance department evaluate the feasibility of investment projects? By considering their financial viability, potential return on investment, and alignment with the company's strategic objectives. What are the potential benefits of utilizing external funding for investments? Can provide additional capital, diversify funding sources, and leverage the expertise and resources of external investors. How do investment decisions impact the financial statements of a company? Investment decisions affect the financial statements by influencing assets, liabilities, revenue, expenses, and ultimately, the overall financial performance and position of the company. How can financing decisions impact the capital market perception of a company, such as issuing stocks or bonds, can impact the capital market perception of a company, affecting its stock price, credit rating, and investor confidence? What is the role of financial analysis in both investment and financing decisions? Provides insights into the potential risks and returns associated with investment projects and financing options, aiding decision-making and ensuring financial feasibility.